If you're an investor in India, you've definitely thought about this. It's the big question. Do you build your portfolio for that steady, reliable income, or do you chase that explosive, high-octane growth? It is the classic showdown, right? Dividend versus growth stocks. And today, we're going to break down which one is right for you, and this is the important part, when.
So what's it going to be, the reliable dividend payer or the high-flying growth stock? That's the core dilemma we're tackling. But the answer isn't some simple one-size-fits-all thing. The right strategy really depends on your goals, how much risk you're comfortable with, and, this is absolutely crucial, what the market is actually doing right now.
All right, let's get into it. Before we can pick a winner, we need to know the fighters. So think of this like a tale of two completely different athletes. Each one has their own unique strengths, their own game plan, and their own ideal conditions for winning.
So in one corner, we've got the marathon runner, dividend stocks. These are your seasoned veterans, right? Mature, stable companies that just run a steady race, paying out regular income and holding up really well when things get tough. And in the other corner, we have the sprinter, growth stocks. These are the explosive, aggressive competitors focused on one thing and one thing only, speed. They reinvest every single rupee to get bigger, faster, and deliver that breathtaking growth.
Okay, let's take a closer look at our marathon runner. Dividend stocks are basically shares in established, profitable companies. They've already had their big growth spurt. And now, instead of just hoarding all that cash, they share their consistent profits with you, the shareholder, in the form of regular dividend payments. We're talking about stable sectors like mining, utilities, financials, kind of like the bedrock of the economy that gives you a nice cushion when the market gets a little shaky.
And this slide right here shows you exactly what I'm talking about. I mean, look at these household names in India. You've got Vedanta and Coal India offering these incredibly high dividend yields. That's the cash they're paying you just for holding their stock. But look over at that last column, 10-year ROCE. Now, that stands for Return on Capital Employed. In simple terms, it just measures how well a company is using its money to make more money. A number like Hindustan Zinc's, over 60%, is just fantastic. It tells you this isn't just some slow cash cow, it's a highly profitable, super efficient business.
All right, now let's talk about our sprinter. Growth stocks are all about the future. These companies take every single rupee of profit they make, and they plow it right back into the business. We're talking research, expansion, innovation. You're not going to get a dividend check from them, because the entire goal is pure, unadulterated growth in the stock price. They tend to live in these fast-moving, innovative sectors like tech, auto components, and specialty chemicals. Okay, now this is where things get really exciting. Just look at that 10-year compound annual growth rate, the CAGR. Companies like Uno Minda and KI Industries have grown at over 45% per year for a decade. That is some truly explosive wealth creation. But, of course, there's a catch. Look at those PE ratios. That's the price-to-earnings ratio, and it tells us how much investors are willing to pay for each rupee of profit. These high numbers mean the market has massive, and I mean massive, expectations for future growth already baked right into the stock price.
So, we have our two contenders. But who actually wins? Well, you know what? That depends entirely on the arena they're competing in, which is the economic cycle. The performance of these two styles isn't constant at all. It changes dramatically depending on whether the economy is booming or, well, busting.
See, every market moves through these four basic phases. First, you've got expansion. That's when things are good and getting even better. Then you hit the peak, when everything is just firing on all cylinders. But inevitably, that's followed by a contraction or a recession, when the economy starts to slow down. And finally, you get the recovery, when things bottom out and start to turn around again. Understanding where we are in this cycle is really the secret to smart investing.
Okay, you really have to see this chart, because it tells the whole story. In a bull market, when things are going up, our sprinter just shines. Growth stocks, they're in red, they return 25%, beating dividend stocks by a solid 7 percentage points. But watch what happens when the cycle turns. In a bear market, dividend stocks provide that crucial defense, falling only about 8% on average, and growth stocks, they plummet 15%. This just perfectly illustrates that fundamental trade-off. You're choosing between higher returns and lower risk.
But just looking at the returns is kind of like only watching the highlights of a cricket match. To really understand the game, you need a ringside analysis. We need to look past the surface and dig into things like risk, taxes, and the incredible hidden power of compounding.
So, let's talk about risk. Professionals use this tool called the Sharpe ratio. Now, forget all the complicated math. It basically answers one simple question. Am I getting enough return for the amount of risk I'm taking? A higher ratio is always better. And research in India consistently shows that dividend stock portfolios have a higher Sharpe ratio. You're getting more bang for your buck when you factor in the risk involved. Now, let's talk about something every Indian investor needs to master: taxes. And folks, this is a total game changer. Dividends are taxed as regular income at your personal slab rate. So for top earners, that can be over 42%. But the capital gains you get from selling a growth stock after 1 year, that's taxed at a much friendlier flat rate of 10% on gains over 1.25 lakhs. Just let that sink in for a second. This isn't a small difference. It is a massive structural advantage for long-term growth investors.
And here's a little secret that most retail investors completely miss. When you see the Nifty 50's performance on the news, that's usually the price index. It only tracks the changes in stock prices. But there's another version called the Total Return Index, and it assumes you reinvest all your dividends. Well, that simple act of reinvesting has historically added an extra 2 to 3% to your return every single year. Over decades, the power of compounding turns that little difference into an absolutely enormous one.
So, what's the final verdict? Is it the marathon runner or the sprinter? Well, the truth is, a winning portfolio needs both. The smartest approach isn't to just pick a side and stick with it. It's to build a dynamic, all-weather strategy that can adapt to the market's ever-changing seasons. Okay, let's get into the actionable playbook right now. When the economy is expanding, you want to be overweight in growth stocks. You want to capture that upside. As the market starts to peak and valuations look a little crazy, you start shifting towards the safety of dividend stocks. In a full-blown contraction, your portfolio should be dominated by these defensive dividend payers. And then, as the recovery begins, you slowly and carefully start to rotate back into growth. That's how you play both offense and defense with your money.
So, let's lock in these key takeaways. First, prioritize companies that grow their dividends consistently, not just ones with a high yield today. That growth is a sign of a really healthy business. Second, always check the free cash flow. That's the actual cash a company generates to make sure its dividend's safe and not some kind of trap. Third, be smart about taxes. Use that to your advantage. And finally, and this is maybe the biggest one, ditch the static set it and forget it portfolio. You need to embrace a dynamic strategy that adapts to the economic cycle.
So we're going to leave you with this final thought to chew on. Take a really hard look at your own investments. Ask yourself, is my portfolio built to win yesterday's race, or is it strategically prepared for whatever cycle is coming next? The answer to that question could make all the difference to your financial future. Thanks for tuning in.